Welcome to the weekly market recap with Sampath Securities. Let's take a look at some of the latest developments in the Sri Lankan economy and financial markets. Sri Lanka's tourism sector recorded a stronger start to July 2026, although visitor arrivals remain below the levels recorded during the same period last year. According to the provisional data, Sri Lanka welcomed 34,721 tourists during the first 6 days of July. This represents a year-on-year decline of 3.6% compared to the corresponding period of 2025. However, daily average arrivals improved to 5,786 visitors compared to 3,889 recorded during the first 6 days of June. Despite the improvement, daily arrivals remain below the 6,000 visitors recorded during the corresponding period of July 2025. India remained Sri Lanka's largest source market during the first 6 days of July, contributing 8,192 visitors or 24% of total arrivals. The United Kingdom ranks second with 3,136 visitors, followed by Australia with 2,640 tourists. China recorded 2,194 visitors, while Germany contributed 1,538 tourists during the period. With the latest arrivals, Sri Lanka's cumulative tourist arrivals for 2026 surpassed 1.18 million. However, year-to-date arrivals remain 2% lower than those recorded during the corresponding period of 2025. India also became the first source market to surpass the 300,000 visitor milestone this year. A total of 301,875 Indian tourists have visited Sri Lanka so far in 2026, accounting for 26% of total arrivals. The United Kingdom remained the second largest source market, while China moved into third place, overtaking Russia. Sri Lanka has set a target of attracting 3 million tourists and generating $4 billion in tourism earnings by the end of 2026. According to the latest figures, the tourism sector will need stronger growth during the second half of the year to achieve those targets. Foreign investors recorded a net inflow into Sri Lanka's government securities market during the week ended 2nd of July 2026 as the Sri Lanka rupee continued to recover from recent depreciation. According to central bank data, foreign investors purchased a net $3 million worth of government securities during the week. Despite the latest inflow, the government securities market has recorded a cumulative net foreign outflow of approximately $13.7 million so far this year. The Sri Lanka rupee also continued to strengthen during the period. According to the report, the rupee had depreciated to around 354 against the US dollar on 21st May before recovering to around 330 by week ended 2nd July. The report noted that the rupee had remained broadly stable for more than 3 years before its recent depreciation. The weakening of the currency was attributed to high fuel and vehicle imports together with the continuing conflict in the Middle East. As of 2nd July, the Sri Lanka rupee had depreciated by 7.7% against the US dollar since the beginning of the year. The report also stated that the government securities market recorded a net inflow of more than 14.5 billion rupees during the previous week, following signs of stability in the exchange rate. Globally, investor sentiment remains cautious due to concerns over the economic impact of the latest escalation of tensions in the Middle East. During 2025, Sri Lanka attracted total foreign inflows of approximately 71.5 billion rupees or around $234.4 million into government securities. Analysts noted that Sri Lanka's deflationary policies in previous years had supported foreign investment by helping to contain imports. However, inflation has increased over the past 3 months following the gradual rise in fuel prices. The report also noted that fuel prices were reduced during the last week of June. Meanwhile, the central bank increased its key monetary policy rate by 100 basis points in May to contain inflationary pressures arising from stronger demand. The Export Development Board says the proposed 12.5% tariff announced by the Office of the U.S. Trade Representative is not a new measure but part of the ongoing reciprocal tariff negotiations with the United States. Addressing a media briefing, EDB Chairman Mangala Vijayasinghe explained that Sri Lanka was initially subjected to a 44% tariff when reciprocal tariffs were announced on 2nd April. He said the tariff was subsequently reduced to 30%, then 20% before both parties agreed on a 10% rate. According to Mr. Vijayasinghe, the current 10% tariff arrangement is due to expire in July, after which the proposed 12.5% tariff is scheduled to take effect. He said the Trade, Commerce, Food Security and Cooperative Development Ministry is continuing discussions with its United States counterparts to prevent the proposed tariff from being implemented on 24th July. Mr. Vijayasinghe also expressed confidence that Sri Lanka could avoid the proposed tariff if the two countries succeed in signing the proposed trade agreement before the deadline. He further stated that Sri Lanka's deadline to submit its appeal is 9th July and expressed optimism that United States would give favorable consideration to the country's representations to secure a competitive tariff rate of between 10% and 12.5%. According to the report, the Office of the U.S. Trade Representative issued a notice on 2nd June proposing responsive trade measures under Section 301 investigations involving 60 economies. The proposal includes an additional ad valorem tariff of either 10% or 12.5% on imports from the affected economies subject to specified product and trade agreement exemptions. Sri Lanka is among the economies proposed to face the high 12.5% tariff after the review process identified concerns relating to the enforcement of prohibitions on import of goods produced with forced labor. According to the proposal, the tariff is scheduled to come into effect on 24th July unless amended following the review process. The Asian Development Bank has lowered its economic growth forecast for developing Asia and the Pacific in 2026, while projecting Sri Lanka's economy to grow by 4% this year. According to the ADB's latest Asian Development Outlook released on 10th July, the region is now expected to grow by 4.9% in 2026, down from 5.5% recorded in 2025. The latest forecast is also 0.2 percentage points lower than the ADB's projection released in April. The report attributes the downgrade mainly to prolonged disruptions in global energy markets caused by the conflict in the Middle East. However, the ADB has maintained its regional growth forecast for 2027 at 5.1%, expecting economic activity to recover as these pressures gradually ease. For Sri Lanka, the ADB forecasts economic growth of 4% in 2026. Meanwhile, regional inflation is now expected to increase to 4.3% this year compared to 3% in 2025. The ADB said the high inflation outlook reflects continued pressure from energy prices, fertilizer costs, commodity prices, and supply chain disruptions. According to ADB chief economist, economic growth across developing Asia and the Pacific remains resilient despite continued external challenges. He stated that policymakers will need to strike a careful balance between supporting economic growth and containing inflation. The report also warned that renewed geopolitical tensions, tighter global financial conditions, and high borrowing costs remain key risks to the regional outlook. It further noted that rising tariffs, trade policy uncertainty, and increasing fertilizer prices could place additional pressure on economic activity, agriculture, and food security. Among the major economies, the ADB maintained its growth forecast for the People's Republic of China at 4.6% in 2026 and 4.5% in 2027. India's growth forecast for 2026 was revised down to 6.6%, while the 2027 forecast was maintained at 7.3%. The report also lowered growth projections for Southeast Asia and the Pacific, citing weaker domestic demand, slower tourism growth, rising inflation, and higher import costs. Let's take a look at this week's Treasury-bill auction results. With the recent Treasury-bill auction, the 91-day T-bill rate stands at 10.21%, down by 2 basis points, and the 182-day T-bill rate stands at 10.30, and the 1-year T-bill rate stands at 10.21%, up by 1 basis point compared to the previous week. Thank you for watching. We'll be back next week.